Welcome to the daily update, where I'll go over the action in the market from Monday, July 21st, and we'll see how things look for Tuesday, July 22nd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, we closed positive, but we gave up a lot of the gains as the afternoon unfolded. We were looking pretty good and set a new intraday all-time high. And looks like everything was firing on all cylinders, and then we just saw a bit of a rollover late in the afternoon. Now, we're still looking positive on all time frames. We're below average with volume, but we just want to be aware that the market's still looking kind of tired, as evidenced by the late day selling that we saw. All right, so right at the open, we had a higher open. Futures were positive, and prices rose above R1 pretty quickly at 63.13 and R2 at 63.30. Looked like we were off to the races there. Then we were able to hold on to those gains for most of the day above R2, and then we saw the late day selling that took prices back down below R2 and R1 and closed slightly positive. We're only up 0.14%, below average with volume there. And as I said, we're positive on all time frames. And we did see interest rates coming down a bit. That helps stocks. The dollar is also going down, which is helping stocks. And we did get the leading economic index that I'll go through here in just a moment. The big deal in Tuesday's session is going to be Jerome Powell's speech. In fact, there is no economic reports that'll be released. So it's just going to be, what does he say? Is it going to be, let's wait and see? That's kind of the stance that the whole Fed has been taking. And there's some real pushback going on between the Fed and the current administration. And we'll have to see how that all ends up playing out. Okay, some comments. So we did set a new intraday all-time high, and we had good earnings reports. And so far, earnings season seems to be humming along really well. That may give some support to the market as we work our way through the majority of earnings season, which will pretty much be this week and next week. That's when most S&P 500 companies will report. There's optimism about trade deals. Of course, we got the Fed meeting on July 30th, and then Liberation Day 2 is going to be August 1st. Are things still going to stay more positive? Or are we going to drift more over back to what we saw in March and April, where things become more negative? Now, I've been trying to point out that about halfway through July, that's when we start to see some weakness in the market. We're not really seeing that yet. We're seeing cracks under the surface, but we're not switching over and seeing any kind of a decline that has any conviction behind it. But when we get more into August and September ends up being the worst month of the year. That's when we might see more of a pullback, but things could still stay positive in the bigger picture, even if we pull back. But of course, there's all these variables out there with geopolitical events and what could come out of the White House as far as trade deals and tariffs that could switch things over. And we saw, at least in Monday's session, some selling into strength as we went into the close. So it really didn't bode well for the confidence of Monday's session, but mega caps still held up fairly well. And we still are seeing pretty good momentum. We have a new addition to the list. The CCI 20 is on the list now, where it was not, but just the Williams percent R. The Stochk RSI, it's not on the list. Williams percent R is still looking good as far as short-term momentum. The stochastics, of course, they take longer to roll over, but they're still giving us extreme positive readings. And then the slope oscillator, which is negative, but giving a very high reading. And then the RSI based on 9 periods. That's the short-term version there. We're back up into the +3 channel with the standard deviations chart, more in the intermediate term. Rate of change 50, that's still on the list and has been here for a while. And then other momentum oscillators, which are actually turning negative, but they're giving extreme positive readings. The Sean trend meter is still looking pretty extreme there. And then we're still far away from the 50 period moving average as measured by the boom indicator. No change to the overall scenario. We'll see if anything comes out on Tuesday to warrant what the Fed may or may not do or what they might change. The dollar was down, interest rates were down, we're 4.37%, where after Friday we were at 4.43%. So that did give some support to stocks, especially earlier in the day. And we're still extreme positive here. Now, again, we're just in positive territory because we dropped down below 75. But the context is that the market is pretty exuberant. But we've been this way now for a number of trading sessions. So we're just kind of camped out with a positive attitude as far as sentiment. And we're still positive with the trend. Green line's above the red line. We're still trending up both in the short and intermediate term. It looked like we were starting to weaken with the trend, but on the daily side, both the short and intermediate term are still showing strengthening trends. And I'm keeping the bias at mixed. We were up, and it was a fairly positive day, but to see a lot of those gains evaporate, and we ended up being mixed at the index level. There were other areas of the market that were down, where the S&P ended up being slightly higher. And I'm keeping the momentum right now at positive to mixed. Okay, so we just had the leading economic index down 0.3%, more than the 0.1% decline they had expected. Last time it was revised to being unchanged. So here is the chart. Now there are two lines on this chart. The blue line, this is the LEI. This is what we really follow here. And this continues to decline, and it's starting to create more concerns about recessions. But if you look at the black line, it's continuing to go up. This is the Coincident Economic Index. This is more of how things are right now. And all the different areas that make up this black line, they're continuing to go up, but yet the LEI itself continues to go down. So we're seeing quite a divergence between the two here. And then this is the one that a lot of folks point to, and I watch this pretty closely as well. When we come below this red line, that's a recession warning. But we had one before and didn't go into a recession. We're getting one again as the LEI continues to decline here. What I'm keeping an eye on is the employment. We still have initial and weekly jobless claims, and continuing claims are still looking pretty strong there. The employment report is still fairly strong, and that's kind of holding things together. We had retail sales last Friday that came in greater than expected. We had CPI, which was greater than expected, but then we had PPI, which was weaker than expected. So things that are showing that the economy is still kind of humming along, but still we see this blue line coming down. And a lot of folks will point to this and go, ooh, ah, because you can see other times when we go below the red line, typically we'll go into a recession after that. But it didn't happen back in 2022 and into 2023. We were recovering, and now we're starting to go back down again. Okay, here are some blog posts from Isabel Net, getting up to the point where we're looking more positive than negative as far as equity positioning, and equity being stocks here. So that continues to improve. Forward PE multiple, I go over this in the intermarket analysis video over the weekend. We're overvalued, whether you look historically, whether you look forward. This chart looks forward, where we have the 10 largest stocks coming in at 28. We use a 10, 15, 20 scale, and we're well above 20. And this is why we consider the market overvalued, but we can be that way for years. And then you take the rest of the stocks, and they're a little more reasonable here. You take out the top 10 stocks, and we're coming in at 20, which is still expensive. But if the earnings can justify stock prices going up, you can buy something that's already expensive with the hope of selling it when it's even more expensive. Okay, then realized and consensus earnings per share growth, going back and showing 2024 and then comparing it to now here for the S&P, where it's not as robust as it was before, but still positive. And so that's what we've really been seeing, the earnings projections coming down lately. But then when you go out to 2026, things are looking all happy again. And that's typical to look out into the future and be more optimistic about what's happening there. And then this also compares it to the equal weight, the Nasdaq 100 mid caps, and of course the small caps, Russell 2000. They're just going to be all large cap stocks by the time we get to 2026. But this will be adjusted and tend to come down as we go forward from here. Then we get this periodically as well. This is another way of looking at the PE ratios. Here's the PE of the S&P 500 at 22, which is above that 20 level. And then we have three sectors that make up the S&P. They're even more expensive than that. And these are areas that have done quite well, with discretionary doing better. It was lagging there for a while, but from a PE ratio, it's still quite expensive, with tech being, my goodness. I mean, this is the big growth area, and it's up over 30 there. And then we have staples, which are equal to the same PE ratio of the S&P 500, and even materials, which have been doing okay, and communication, they're also considered expensive. And then we go down the list with healthcare, energy. Things go a little crazy in the world, energy goes up, and then it starts to back off. And where healthcare is more of a defensive thing, since you have to have healthcare no matter what's going on in the economy. And so these tend to be more undervalued right now. But is the climate better for defensive stocks to be leading like they were back in 2022? No, not at this point. If you watch the intermarket analysis video, the growth is outperforming value. And these are considered to be more value, more defensive areas of the market. Okay, equity positioning is still a little below the level implied by the second quarter earnings, because earnings are coming in positive and they lowball this. And then when the report comes out, it's like, oh, they beat estimates. And then you see some of the buy the rumors, the stock price may go up. And then the report comes out, it's stellar, it's really good, and the stock sells off. So this is just showing that, okay, we could still go up a little bit from here as far as earnings that are being reported. Then S&P 500 foreign revenues by sector. This is where the tariffs come more into play here. And you have tech. Of course, they do a lot of business overseas, and it ranks them: materials, energy, communication, and all the way down to utilities. So we're not generating a lot of electricity and then sending it off to Africa or something here. So most of their revenues are domestic, internally. And then I wanted to include a little bit of a definition here: effective versus statutory tariff rates. Okay, so a statutory tariff rate, that's the blue that we're seeing right here, is the official tax rate on imported goods. All right, as determined by law or trade agreement. So 10% tariff, 20, 25% tariff, whatever it is. The effective tariff rate, on the other hand, is the actual average tax rate paid on imported goods. And so this is considering factors like exemptions, because not all products have to go and have tariff placed on them. Any kind of trade deals, maybe for specific industries, and other complexities that can reduce the amount of tariffs collected. So that's kind of the difference that we're seeing here. Just the exceptions are more of the effective rate. But the headline and what everybody talks about is usually the statutory rate. My goodness, that was a slip of the tongue there. Okay, then the trade weighted US dollar, it's going down, and Goldman Sachs is considering that in the future it's still going to continue to go down as well. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, then here is the intraday chart, and looking pretty good. Nice solid start, and didn't see a real move up and then a drastic move down. We held on to the gains for most of the day, and it's like, okay, maybe we're just going to drift sideways going into the close. Things really started to slow down, But then, here we go. We started to see a bit of a drop, then a little bit more drop. We fell below R2, and eventually we held up at R1 for a while and then fell down below that. We still closed positive above the daily pivot, but it's kind of frustrating. It's like a big M here with not too much in the middle going right there. Not quite like the golden arches. All right, and we're pretty much flat in the initial overnight session. People are on vacation. People are doing things. Volume is lower, and it's the nice weather. They're out boating or golfing or doing whatever people do overall. And so unless something really big happens, the stock market tends to settle down. We're still looking good here. The blue line is above the red line, even though we did see some late day weakness with these lines with the intraday chart, but value did underperform growth. This is still looking good. The intraday growth to value ratio for the S&P, that's overall still looking pretty good there, where growth did better. So our end of day charts, growth was up, where value was up just a little bit. It was virtually unchanged. But when you look at the mid caps, growth was down more. And with the small caps, growth was down more, actually negative. So coming down a little bit with our end of day charts here with small cap growth to value, a little bit of a tick down with mid cap growth to value, and coming down just a little bit with S&P growth to value, but still all three of these charts are still looking fairly solid, showing growth is outperforming value, and looking pretty good here with the growth to value ratio between these two ETFs. And going back up a little bit and improving here when we look at the equal weight discretionary versus staples. So that's still hanging in there. This going down is positive. This is value to tech, which is the biggest part of growth. So when this ratio goes down, that's more positive for the market. And still okay here. We were getting a little concerned that the ADX may drop below the moving average. Well, there was enough of an upward move here to turn it back up. The green line's going up, the red line's going down. So we're still in a strengthening short-term positive trend. And seeing that same thing here in the intermediate term. Green line's going up, red line's going down above the moving average. And below average with volume here, and we dropped off again. And that might be typical, again, unless something major happens to bring either buyers or sellers into the market. Okay, then weekly look at sentiment, still coming in pretty high here at 76.4. We're coming in at 74 with the fear and greed index that we follow, and that changes throughout the day, and then they have a closing value, and I tend to prefer to follow that one, where this is more of a composite of different things together, and we only see this chart once a week. Also, another look at sentiment here. This is a little bit bearish. These are legal insider transactions. And when this red line is going up, we're getting more into the bearish area. And when we look at the VIX, though, we're still looking pretty good here. We're below 20. We were up just a little bit on a closing basis, but we're below these declining moving averages with the line chart and the bar chart. Also below the moving average with the VIX of the VIX, as we've been seeing volatility staying lower now. We're still getting a reading with the skew index, which is a variation of the VIX. We're up into this red area. Now, it's when it spikes up and comes back down, but then we can get we think, okay, it's done, and it's finally coming back down, only to go up higher again. But this is just that the market is expecting some kind of a big move when we look at the skew index up in this red area. All right, so we declined with this fear gauge, where we actually ticked up with the other fear gauge. So not our confirmation there. And a little bit of a tick up with the equity put call ratio daily chart, but we're still going down with the 5-day chart and still declining with the 10-day chart. And this is still looking good. Risk on to risk off ratio, it didn't change all that much, but for the most part, this has been going up, and that's positive. This means the market's more on offense rather than defense. And we are getting a bit of a pickup here. We were flat, but we're well above this band here when we look at volatility risk premium. This is anticipating that some fear is coming back into the market. Okay, still holding up okay with the advanced decline line based on price and volume. Down a little bit based on price, pretty much flat based on volume. Little bit positive, just chopping right around the zero line with our advanced decline oscillator. And declining but still above zero with the short and intermediate term advanced decline ratio. And falling off a bit here with the new highs. Now setting a new intraday high, you would think that would have generated some new highs here, but it didn't. They actually came down. And so our 5-day chart is going down and our 10-day chart is back to going down. It looked like this was improving, but not seeing this green pretty strong or stronger than it was in Monday's session is pulling the averages down. And we're getting a mixed picture here. We're still positive since we're above the red line here with accumulation distribution, but you can see we're rolling over and the boom indicator is picking that up and we're actually dropping below the moving average where it was slightly positive after Friday. But the chicken money flow is positive. The histogram's going up and the red line's going up, but the chicken oscillator is declining. So we're not seeing a lot of confirmation right now with our three smart money indicators. Declining, but still positive with the vortex. Still above the moving averages with all our different advanced decline line studies. And declining here with those stocks above their 20-period moving average, but still above 50. And we did decline with the 50-period moving average study, 100, as well as the 200. But all of them are still above 50. So they're hanging on to a positive reading that way. And here's just the daily chart where we came up to this dashed line here. This is an overhead resistance point, and that's about where we topped out. And so that was kind of about all we could do in Monday's session, and then we started coming down from that. Is this going to turn into something more? That's what we're going to watch for here. We're still looking pretty healthy as far as the chart pattern here, but we now have hit this overhead resistance level, and we are below average with volume. And declined a little bit, but still above 50 with the 20, 50, and 200 period moving averages on the S&P. Improving with the Stochk RSI, but still below the midpoint. So we're not up here in this high area where usually that shows good short-term positive momentum. And we did decline, but we're still barely extreme positive with the Williams percent R. Going up with the CCI 14 and the CCI 20, just barely above this line. So not real solid positive short-term momentum, but still leaning more in that category. And we did decline below the moving average with the short-term stochastic, still looking extreme positive and above the moving average with the intermediate short-term. And now we're starting to really flatten out here with the longer-term stochastic, but we're still above this green line, giving us an extreme positive reading. Still positive, but below the midpoint with the force index. The short-term trend, 20 periods, still going up with the green line and the blue line, but they're starting to converge more with each other. That means things are slowing down, and we're just barely up into the +3 channel with the standard deviations chart. Now, intermediate term, declining but still above zero with the balance of power. Still looking pretty good here. This is the 10-day simple moving average in green. We're above all of the lines, and we're slowing down a little bit with the green line, but they're all still tending to go up. And positive with the go, no go. This redrew again and is now looking more positive. And still at the highest high value here. That's positive. And still getting a little bit long as far as time, according to the Landry Light, even though this is positive. Still positive with the proper order. TTM squeeze looking a little more negative. Not extreme anymore, below the black line, darker shade of blue, and continuing to decline here. And still giving us an extreme reading with the rate of change going back 50 periods. Trailing along just barely above zero with the ease of movement. Still looking positive. We're above zero with the oscillator. When we look at the Arun indicator, it still means there's more buyers and fewer sellers, so that's still positive. And still below zero with the S&P McClellan oscillator, so we're going down with the summation index based on price and volume. Also still below zero with the NYSE McClellan oscillator. This is more the internal cracks that I'm talking about here. So we're declining with the summation index based on price and volume for the NYSE. And getting a mixed picture here. We're rolling over. We were positive after Friday with the Switzerland trading oscillator. Now we're going down based on price, but we're leveling to still going up here based on volume. So that's a mixed picture. And here's the momentum oscillator. Still extreme since we're above the red line, but we're dropping below the moving average. We're also dropping below the moving average based on price and volume. This is another part of the cracks that I'm talking about. Below 50 with the PMOs that are rising, and that did decline. We're also dropping further with the buy signals and trailing off, but still giving us a pretty high reading with the PMOs that are above zero. Neutral again here, and this is not a really good looking bar to open, set the high, and then actually close below the open and near the low for the day. Positive though with the parabolic SAR, and extreme positive with the slope oscillator, but still declining below the moving average. So that means the context is negative. Also negative with the MACD, which is more short to slightly intermediate term. So we're rolling over with our short and intermediate term oscillators, seeing a little bit of rollover here with our two long-term oscillators, the TRIX and KST. KST is flatlining right now, right on top of its moving average, and we're negative with the copy curve. So momentum has switched more. And it's not that this is really switched over more negative, it's that we're losing that positive thrust that we've been seeing. That's how these momentum oscillators are calculated. And still looking pretty good in this darker green area with the Shaw trend meter, still above 50 with the money flow and the ultimate oscillator, even though both declined. Still above an advancing moving average with on-balance volume. That's positive. And getting a high reading with the RSI 14, which is intermediate term, but we're just barely extreme positive with the RSI 9. Intermediate term trend based on 50 periods. The red line, the blue line still going up, even though we're below the red line here. And above all the plotted moving averages. And as I tried to point out over the weekend as well, a lot of this, going back to May, any kind of sideways or down days or consolidation that we've been talking about, the positive thing here is that all of it's been taking place above the 20 period moving averages. And that shows a stronger market. We'll see if it can stay that way. And we're not too far away from the 20 period moving average, but we're still far away from the 50 period moving average as measured by the boom indicator. Still declining here with the bullish percent index. It never did go above its moving average. So the context here, even though it's a high reading, is that this is negative. And we're flat with the NYSE bullish percent index and ticked down a little bit with the NASDAQ 100 bullish percent index. The Pring bottom fisher buy signal is just about ready to go away. Again, it's like, what kind of a bottom was this picking? We were going up when this was generated. So haven't really put a lot of faith in this, but because it was generating a signal, I wanted to include this chart. Okay, then we look at so far, this is the weekly chart. And I've been pointing out how this is a pretty constructive pattern that we're seeing of, for the most part, higher highs and higher lows. And we're up a little bit so far for the week. And on a trending basis, the different ways we look at it here with the Heiken Ashi, this is still positive. We're positive with the Kegi chart, we're positive with the Renko chart, and positive with the three-line break chart. So from a trending perspective, we're still positive there. Longer term, still looking okay with our 150 and 200 period moving averages. Positive on all time frames with all the different stock indexes that we look at. And bonds have switched back over to positive in the short term. Commodities, and I pointed out a little over the weekend as well, the CRB index is going up, and that could be somewhat inflationary. That might give some concerns to the market. Still negative on all time frames with the dollar. And we did see communication, big growth area. That was the strongest area. And that's really what held things up in Monday's session. Then we see energy, healthcare, more defensive areas. They ended up being down, with energy being down more than 1%. Tech, a little bit higher there. Discretionary, a little bit higher there. Those are the three big growth areas that we keep an eye on. And everything is positive. The late day drift didn't really cause anything negative, but we had staples with a BPI across about 50. It's just bouncing. We had an alert last week. We had a couple where it would go above 50, then below 50, above 50. Now that's where it's at. Now we did have a bullish crossover. This is called a golden cross here, both with the real estate sector and materials. So the real estate, that's more of a defensive area. And we are above 6,300, and we set a new all-time high on an intraday basis, as well as the NASDAQ and NASDAQ 100. Everything started off just looking really good. Canada even got into the game there with another new all-time high. So the alerts that were triggered ended up being positive. We just gave back a lot of those gains as we went into the close. And so the big growth area here, NVIDIA was down, Microsoft was unchanged, Apple was up. Not really big changes here. Communication, Google and Meta were both up. Discretionary, Amazon was up where Tesla was down. Then healthcare, seeing a lot of red over here, and not any real conformity. A lot of different colors in the market carpet here. And we're seeing a little bit of an underperformance here with the equal weight. That's the red line. It went down where the S&P actually ended up closing up on the day. And we're seeing that also in this ratio. When this goes up, that means the weighted version of the S&P is outperforming the equal weight version. And just kind of chopping along sideways here. The Dow is down just a little bit after recently generating a golden cross. Neutral with the Elder's Impulse system. This is looking better though. The NASDAQ, it's actually above this R1 pivot point. It closed well off the high as well, but this is looking better here. And the NASDAQ, if you watch again the intermarket analysis video, the NASDAQ is outperforming the NASDAQ 100, which you might think would be negative, but that just means there's more stocks that are participating. And we are still positive with the Elder's Impulse system for the NASDAQ. Still bumping into this line here, where we seem to have slowed down about the time we hit this with the NASDAQ 100. Even though it's going up and still setting new all-time highs. I mean, these aren't like massive blow-off tops. Just trudging our way a little bit higher. NASDAQ 100 still a little bit below this R1 pivot point here. Also a pretty healthy looking chart pattern overall. And positive after being neutral with the Qs when looking at the Elder's Impulse system. But the momentum just kind of drifting lower and lower. And just like other momentum oscillators, it can't help but do this because as we've been going up and slowing down, higher values are being calculated with the momentum oscillator, and that's what causes these to go down. But then a lot of people see this and they go, oh, we're rolling over, negative momentum, I better sell. And then it ends up being a self-fulfilling prophecy. Okay, still hanging out right around at the 200-day moving average with the S&P 600, still above the 200-day moving average with the Russell 2000 small caps, neutral with the small caps with the Elder's Impulse system, just kind of chopping along a little bit below this R1 pivot level. Now, if we can stay above this, we might be getting ready to a golden cross for the mid caps, but we have to stay above both of those moving averages for that to happen. And neutral with the Elder's Impulse system for the mid caps, well off of the highs, but did close higher here with the Wilshire 5000 and a little bit higher here with the total U.S. stock ETF. Financial sector ended up being down, but it's still looking pretty solid there. However, and I've been trying to point this out recently too, when we look at the ratio between the financial sector and the S&P, we are underperforming and dropping back down further below the 200-day moving average of the ratio. FANG index, all-time high. These are the big stocks, and this is what led things higher and actually helped the market stay together in the late afternoon. So Apple was up 0.62%, still in a downtrend though. We're in an uptrend with Amazon. It was up 1.4%. Google was up 2.72%, getting really close to a golden cross. Microsoft unchanged, but one of the better looking charts that's been performing since we were coming up out of the lows in the spring. Meta was up 1.23% above its 50-day moving average. Nvidia in an uptrend down 0.6%. Tesla just kind of messing around its moving averages here. It was down 0.35%. Netflix trying to get back up to its 50-day moving average. It was up almost 2%. And the semiconductors doing well here, barely up, but still that's another new all-time high on a closing basis. And the SMH semiconductors were up as well, setting another new all-time high and looking pretty solid there. This ratio going down is positive. That means staples are underperforming the tech sector. And kind of not really strong between U.S. and world stocks here with the correlation on the short term, still drifting a little bit lower here with the longer term. Oil ended up being down, still getting more into the mid-60 range. And the dollar, even though it says it was up here because it trades 24/7, I just go with the closing price at the time the stock market closed, and we were down with the dollar, and we're in a downtrend there. Trueflation, latest reading coming in at 2.05%. We had inflation from CPI last week at 2.7%. So this is coming up with a lower inflation rate. And we're below the 4.5% level. We did see And this kind of also helped the stock market really, especially at the open. It led to some of the gains and it held things together as the market was carrying out the day. And we're coming back down about to the 200-day moving average with the 10-year yield still above the 50-period moving average with the 10-year based on price. And doing okay here with the Qs to S&P growth to value ratio, a little bit above the moving average with discretionary to the S&P, and looking pretty good with large cap growth to large cap value. So we're above the moving averages when we look at the large caps and mid caps, coming back down to the moving average with the small caps. This ratio going down is also positive. Staples are underperforming the S&P. Staples are more defensive. When this ratio is going down, that means the S&P is outperforming. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook then for Tuesday? We're dealing with earnings, and we're going to have Google and Tesla will report in Wednesday's session. So folks might be a little quiet. There's really no economic reports coming out. So we'll just, and again, it's summertime. So that's about all you can say about that. We're still positive on all time frames, and we are trending. And the only closest thing to an economic report is right when the market opens, Chair Powell is going to be giving a speech. Will he say anything that even causes the market to notice? That's what we'll be watching for there. And then anything geopolitical as it applies to the tariffs and trade wars, anything between Israel and Iran or Russia, Ukraine, or anything else that hasn't happened that could come in and have an impact on the market. So then we'll have on Wednesday, it's a pretty light week as far as economic reports. We'll get the weekly mortgage applications and existing home sales. The big one will probably be initial and continuing claims on Thursday, and then we will get durable goods on Friday. So much lighter than the week we just finished here. And this also shows what's coming up, what the previous reading was, and what the forecast is. Seasonality, we were quite negative for a Monday session for the 21st. Now we switch back and look a little more positive for the 22nd, and we are dealing with the week after options expiration, which tends to be down more than up going back to 1980. So we're neutral to positive with the Dow and NASDAQ, where we're neutral to negative with the S&P, but really no favor one way or the other with that one. But during a post-election year, we tend to hold up fairly well. We actually get a little bit of a bounce as we work our way through the end of July. This is that same thing here, just showing how we see a little bit of a downward move for Monday and a little bit of an upward move now for the next couple of sessions, but nothing that changes all that much on a seasonal basis. Here, second half of July tends to underperform the first half of July. See how that plays out. This is also showing how the second part of July tends to be weaker than the first part. All right, so looking at the three smart money indicators, we are positive with accumulation distribution, but the boom indicator is negative. We're positive with the Chaikin money flow, but negative with the Chaikin oscillator. So yeah, no real conformity there, or confirmation, I should say. And we're negative with the S&P and NYSE McClellan oscillators and summation indexes. Momentum is negative for the S&P, and we're getting a mixed signal with the Swindle Trading Oscillator. Bullish percent index, we're still declining below the moving average for the S&P, and the momentum for the NASDAQ 100 is just kind of drifting lower now. And then over the weekend, I pointed out the long-term special K chart continues to be negative, and we have a very long sell signal generated by the Zahorchak method. That's a full-on -10 right now. Positive signs, still looking pretty good for the most part here. Our growth to value ratios, discretionary to staples ratios, those are good. Positive with the parabolic SAR. We're still positive with the bullish percent indexes for the NASDAQ and NYSE, but they are not really showing a lot of strength either. Ease of movement, money flow, ultimate oscillator, vortex. And the gold here, if you're new to these videos, these are what I consider to be primary indicators. White is if they're a secondary indicator. And if you go the yellow one that I had, the Swindle Trading Oscillator, that's kind of like right in between being primary and secondary. And the financial sector and the Pring Bottom Fisher. But this is about ready to go away. We're probably going to drop below that line there. Here are the pivot points for Tuesday's session, which are already updated on the YouTube community tab. So our conclusion, no change, positive, trending across all time frames for right now. Thank you. Have a really good day, and I will talk to you in the next video.